Good morning, Mike, Managing Directors and Global Partners. Here is your news brief for Thursday, June 25th, 2015. Last fall, China overtook the U.S. as the largest economy in the world when measured by purchasing power parity. However, in straight-up nominal terms, the U.S. still leads by a wide margin. Now, Bloomberg's research unit is predicting China will surpass the U.S. in nominal GDP as early as 2026. It also predicts India will climb from its current position of 9th all the way to 3rd by the midpoint of this century. If these calculations come to fruition, you can see that the top three economies of China, the U.S., and India will dwarf all others combined. Making up the rest of the top 10, Mexico and Indonesia will supplant Russia and Italy. And due in large part to the growth in India, Asia will account for 53% of the total global GDP. In terms of per capita income, China is forecast to rise from 14% to just under half of the U.S. level, while India is expected to increase from 3% to 24% of the U.S. level. Of course, we need to point out that if China's GDP already exceeds the U.S.'s in purchasing power parity and its middle class's income really triples, as Bloomberg suggests, the real purchasing power of China's middle class is going to explode, and India's too, for that matter. These changes will have far-reaching consequences for the balance of global power and, by extension, the currency preferences of the world's economies. Next, we've been warning for some time now that asset prices have once again reached bubble proportions and that bonds are perhaps the biggest bubble of them all. Now it seems other people are also seeing the writing on the wall. We've run 2 stories so far this week of bond fund managers saying they are pulling currency out of the market and holding more in cash, and as this retreat out of bonds occurs, it is only sucking more liquidity out of the market. Back in 2005, the yield on junk debt began diverging from equity prices, signaling the beginning of the downturn that became the credit crisis of 2008. Now that same pattern is happening again, as shown in this chart from Zero Hedge. This has made equity investors nervous as well, and rightly so. Despite recent new record highs in several stock market indices, equity mutual funds have suffered negative net capital outflows for the past 16 consecutive weeks. The last time investors contributed more to stock funds than they withdrew was the week ending February 25th. Since that time, stock mutual funds have experienced net withdrawals of nearly $55 billion, according to Investment Company Institute, a mutual fund trade group. Next, just as one Chinese bank has joined the London gold price setting ritual and another has applied to take part in it in the last week, new reports out of the country indicate that China is continuing work to launch its own yuan-denominated benchmark price setting process in the near future. The decision to approve such a move will come from the People's Bank of China and be administered by the Shanghai Gold Exchange, which submitted a proposal of how the new procedure will work and the rules and regulations its participants must follow to the PBOC a few weeks ago. So now it's just a matter of time before the Chinese central bank issues its approval. Once that occurs, the Shanghai Gold Exchange will have to enlist participants. About 15 Chinese banks are expected to participate, but to add legitimacy to it, some foreign banks will also need to join. If foreign participation in the Asian Infrastructure Investment Bank is any indication, we do not believe the exchange will have any difficulty in finding a few foreign banks to sign up. The major difference between the London Gold Fix and the Chinese Fix will be that the Shanghai Gold Exchange will serve as the counterparty, making sure that all transactions are honored, executed, and delivered. This should make the Shanghai version much more transparent and more difficult to manipulate, which is one of the criticisms of the London process. And finally, gold and silver eagle sales have jumped considerably so far this month compared to May. According to the U.S. Mint, silver eagle sales in the first 3 weeks of June have already surpassed last month's total of just over 2 million ounces, and gold eagle sales are more than double with a week left to go in June. This is being attributed to the continued low relative prices on gold and silver, combined with all the market uncertainty and increasing warnings of a market crash in the near or mid-future. And that's your news brief.